The purpose of this presentation is to present a maturity model for integrated business planning for manufacturing organizations. Some would call this integrated planning and performance management, but what we're really doing is talking about the same thing. So in terms of the objectives, one of the things we want to do is just answer a couple of questions. One of which is, what comprises a mature integrated business planning process? And what capabilities are companies missing? So as we're going through it, there's some of the key ideas that we'll be talking about. First of all, it's going to be manufacturing specific. We make a point of talking about how complexity management fits into the maturity model. We talk about integration from strategic, financial, and operational perspectives. Well, we also talk about both planning and performance management part. And the maturity model, just so that people understand, is that it's based on currently available technology. So one of the confusing things in the industry is that there's a whole bunch of terms about integrated planning or integrated business planning, integrated financial planning. You can see them on the screen. And the question I get is, what's the difference between all these things? Like, if it's integrated, shouldn't it really be integrated? So what we're going to talk about today is a framework that kind of brings all these things together. So some of the terms that people may be familiar with, you can see on the screen, like driver-based planning, activity-based planning. We're going to talk about how all these things fit together. And some of the terms we'll talk about are like rolling forecasts and sales and operations planning. In terms of topics, so the first thing that we'll do is we'll provide a high-level overview of what does a mature integrated planning process look like. Then we'll talk about how complexity fits into the maturity model. Then I'll provide you an overview of what the maturity model looks like. And then there's two components to the maturity model. The first is profit and strategy alignment, and the second is planning and resource quantification. We'll talk about those things separately. There's a few issues that I want to talk about after we talk about the maturity model, just to summarize a few things, and then we'll conclude at the end. So in terms of, if you had to really think about, just from a very simplistic perspective, what does a mature integrated business planning process look like? So if you just ask somebody to describe it to you simply, what would it look like? Well, the first thing is that your strategy, cost structures, and resources would self-adjust to changing market conditions. That's the first thing. Second thing is that you wouldn't find any functional silos in your organization. You'd be managing cross-functionally and working well across both functions and entities. You'd have integrated scenarios, which I'll define in a second, and people would exhibit a business owner mentality culture where there are no unwritten rules, and I'll explain what that is in a minute. Some of the other things that were sort of secondary to those definitions, one would be is that there's no difference between an S&OP forecast and a rolling forecast. It's the same workflow and process. So the two would automatically be reconciled because they're part of the same process. The next one would be there would be no special cost reduction study. So you would always have on at your fingertips where you could reduce costs. You wouldn't have to actually go out and do any sort of special work to figure out what those things were. The next thing, cash flow forecasting, would be a key outcome of a rolling forecast. So one of the challenges that treasury people have now is that it's a big process. So cash flow forecasting would just be a byproduct, if you will, of the rolling forecast and one of its primary outcomes. And the last one would be that the process is such that the cadence allows for lots of scenario planning. So one of the challenges that companies have now is that there's so much work done during a month that there's very little room for doing effective scenario planning. So in a good process, you'd have plenty of time measured in days to actually do really effective scenario planning. So there's three things I just want to touch on in a little bit more detail. The first is integrated scenarios. So there's a lot of things on this screen. And if you read through the questions, you can see that these are pretty detailed questions. But to me, when a process is integrated, you should be able to simultaneously answer all these questions from strategic, financial, and operational perspectives while coping with a whole bunch of business changes. So you can see either addition or a loss of a major customer, supply chain disruption, you can read them all. But these are very interrelated questions. So, a mature process, you're not going to have multiple multiple processes to answer these questions, you're going to have something that actually does it all simultaneously. Next thing is what I call unwritten rules. And a lot of companies, if you read these things on the screen here, so for example, always under promise and over deliver, these are the way people behave given to the way that they feel that they have to behave in order to be successful in a company. And a lot of companies exhibit these sorts of behaviors. And one of the reasons why these behaviors exist, and there's usually a lot of them, but one of the major ones is that target setting, resource allocation, and rewards aren't viewed as being fair. And when you get that situation, you end up having these unwritten rules. And in a mature planning process, people should believe in the fairness of the process, and therefore you should be in a much better position to address these unwritten rules. And lastly, there should be no functional silos. And one of the reasons why I say this is that if you're really going to have an integrated planning process that's supposed to be strategic, it had better address the number one reason why companies don't execute strategy, and that's functional silos. So one of the things that we did was we looked at 28 different research studies, and you can see what the focus was of the research study on the right-hand side of the screen. But the vast majority of them all had functional silos rated as number one or number two as their major barrier to executing strategy. So in a mature IBP process, this should not be the issues. And one of the things we're going to talk about is how you do that. So that's a quick overview of what a mature IBP process ought to look like and how it feels. So let's next talk about complexity in the maturity model. So one thing to understand that there's a lot of confusion in the marketplace in terms of what integration really is. So, especially when it comes to software providers, and a lot of companies will claim they provide integrated business planning solutions. But when you look underneath the covers, you got to look at what it is that they actually do. So if you're a simple manufacturer and you have very few products and very few customers, not a lot of variability, it's not going to take too much to integrate your system and your processes. But if you're a global manufacturer, that's terribly complicated. These sorts of solutions up here are not going to meet your needs down here. And this is really what we're going to be talking about here from a global manufacturing perspective. How do you meet these needs? And the thing is, these tools up here and processes are going to produce minimal value, while these ones down here that address this complexity are going to have the greatest value. So when you think about integrated business planning, one of the things that's clear, and research studies show this, is that companies are not realizing the value out of integrated business planning. And the same is true of other integrated approaches like integrated performance management or integrated financial planning, especially as companies get larger and more complex. And what gets exposed are capability gaps. And these capability gaps represent the difference between what we're calling strategic IBP and tactical IBP. So tactical IBP is currently what people are typically thinking about IBP in the market today, versus something that's really driving profit and profitability and strategy. And one of the key components that's driving this, or one of the key elements that's driving this, is that when you get into more complex organizations, one of the problems you find is that you can't establish effective ownership for these sorts of metrics. So maximizing segment and value revenue, customer retention and service, forecast accuracy, while minimizing inventory investment. When you get into larger organizations, one of the challenges is that organizations can't manage these things from a segment perspective, because if you're in a bigger company, you're going to find that different products and customers have different cost structures associated with them. And if you don't understand the economics of those cost structures, you're not going to be able to manage these things. So for example, from a commercial perspective, it becomes hard to get commercial leaders to manage the economics of the business with these things as drivers. And these are the things that really should be driving your entire business. And having people managing these things should drive the rest of your business, and that's not what's happening. So you end up with people making the wrong decisions. So people make the wrong decisions for four basic reasons. So first, you either have inaccurate models, so they're usually just not mature enough to provide the visibility that you need. Number two, people aren't focused on value. So those metrics that we just saw, people aren't owning them and translating them through the business. Functional silos, so people, the accountability and rewards don't promote the right decisions and behaviors. And fourth, the processes are just too slow. They're fragmented and take too long to respond to business changes. And those are the things, really, when you think about from a high level, those are the things that are driving problems for companies. And those are especially problematic when you try to execute across multiple functions, product and customer segments, business units, and legal entities. That's where more complexity comes in. And ultimately, what this means is that companies lack the ability to plan, manage, and govern outcomes. That's ultimately what the problem is. And there's four capabilities that we're going to be talking about when we go through the presentation: integrated scenarios, trade-off management, productivity management, concurrent process. And we'll talk to you about what you need to enable those things. So from a value perspective, you'll see a number of these things on the screen. These are results of research studies that I summarized. And if you look at them, what's common to all these different research studies is an inability to plan, manage, and govern outcomes. And more specifically, this is the issue, the inability to plan from a strategic, financial, and operational perspectives across functions and business units. And if you look at collectively all these things, the complexity costs really come in around 3 to 5% of sales. It really depends on which study that you look at. But there's just compelling evidence that a lot of companies they're experiencing a value erosion because they don't have the ability to manage outcomes and manage complexity. So that's this 3 to 5% of sales, and you'll see me refer to that. And one of the things is, if you think about the strategic value of IBP, this is a really good guideline to use as a starting point to figure out what the value is to a company. So one of the things, if you're having some of these issues, is that you're also likely experiencing some interconnected management challenges, and these are shown on the screen. And the thing is, when you start getting into bigger and more complex companies, finance will experience some of these. So, for example, cash flow forecasting is a huge problem for a lot of global manufacturers. But the thing is, you can't make decent changes or effective changes to cash flow and foreign currency exposure forecasting without making changes to scenario planning and profit-based S&OP. They're all highly interconnected. So the thing is, if you look at the research studies out there in global manufacturers, these are the things that show up time and time again, like for S&OP, effective engagement of executives in the S&OP process is a problem, integrating it with financials. And over here, you see that rolling forecasts enable rapid response to changing market conditions. These are all things that you'll find in different research studies that are very common to them all. And this is the thing I highlighted here, with the interconnected nature here with cash flow forecasting and scenario planning. So ultimately here, one of the things that's the problem that needs to be addressed when you're looking at mature planning processes is that you need to connect inputs and outputs. So, we continue to plan and manage, the same way that we've done for many years, using functions and functionally based methods, but our strategies and value propositions are all based on horizontal execution. So there's this misalignment. And one of the things that good integrated system ought to do is translate these strategies back through the processes and into the functions, and allow you to manage the intersection points. That's really where the value is in terms of integrated business planning and what we'll be focusing on here. So one thing to just highlight here, and I think it's important for a lot of people to understand, is that really cash flow forecasting is really a leading indicator of how good your integrated planning process is. So anything that's not working well in your process is going to come out in bad cash flow because it just and all the errors or all the inefficiencies and all the gaps really find their way into a bad cash flow forecast. And what ends up happening is that it's really a leading indicator of the challenges that we just saw, and it's also a leading indicator of the value erosion. So from an executive's perspective, especially a CFO and any senior executive, cash flow forecasting needs to be focused on like with laser focus. That has to be, you always have to be understanding, how is this going to improve my cash flow forecasting? Because I think far too often companies focus on the wrong leading indicator. And the same is true of foreign currency exposure forecasting, because if you don't really understand, the flow of inventory and the flow of goods across business units and legal entities, you're probably not going to understand foreign currency exposure either. So that is a quick introduction of complexity and the maturity and how to fix a maturity model. So let's now get into the maturity model itself. So first off, let's talk about what strategic IBP is. And if you look on the internet, there's lots of different ways of describing S&OP, advanced S&OP, and tactical IBP. They tend to be rather lengthy definitions, but ultimately, really what it is, it's a process for planning, managing, governing outcomes, and doing so by aligning and optimizing these outcomes from strategic, financial, and operational commercial perspectives. That's really what it does. So, when you talk about S&OP and supply and demand balancing, that's just a form of managing these outcomes. So one of the challenges is when you're talking about IBP maturity is that there really is no universal maturity model to describe this stuff. So which is one of the reasons for this video. So this whole idea of managing strategic, financial, and operational outcomes is represented in this pink box up here. So we're looking at it from a planning and performance management perspective, and the actual terminologies we use are profit and strategy alignment and planning and resource quantification. So down here is fragmented and siloed is where most companies have been, and what they're trying to get to, especially when you think about digital transformation, these sorts of things, this is really where they're trying to get to. And so these are some definitions of what those profit and strategy alignment and planning and resource quantification. There's some definitions for you there. You can read them at your leisure. But the main thing I want to talk about here is the difference between what strategic IBP and tactical IBP. Tactical IBP is really where companies are at today. The whole idea of balancing supply and demand and having some links to traditional financials. So they're linked. They may be linked to a rolling forecast, but they're not really integrated with it. And when it's really integrated, you look at that, you would also have like a shared scenario planning or integrated scenarios, which most companies don't have. Strategic IBP is what we talked about before, which is planning, managing, and governing outcomes. And if you look at what most companies are moving towards, or what they're trying to achieve, like profitable growth, sustainable cost reduction, all these things, this is really what the capabilities that they need. And the difference between strategic and tactical are these complexity gaps that their companies are struggling with. Now, one of the challenges is that if you look at some of the research analyst firms like Gartner, one of the things that they do a really good job of is looking at, various software vendors from a functional perspective. So they have a magic quadrant for S&OP and one for finance. But here's the challenge. People think that, well, if I use a leading one over here in S&OP and a leading one in finance, that's going to give me like a leading process that gets me to where I want to go. And that's usually not the case. So more often than not, you'll find that they're not supporting more than a tactical process, and you need to be focused on what the strategic requirements are. And the problem is that there's some gaps that are falling between the cracks of financial and operational software vendors. And these are the four gaps that are falling between the cracks, and I mentioned these before, which are inaccurate models, functional silos, value misalignment, and slow processes, and these are the strategic capabilities. The thing that viewers really need to understand is that these are the things that are not being picked up by either software vendor. And one of the related issues is that it doesn't help companies drive the right behaviors, the processes that they enable because of these gaps. And one of the challenges is that you're really not looking at the process more holistically. So if you look at what comprises mature forms of integrated planning, these are the things that ought to be incorporated in there. And these capability gaps really affect all of these different sort of processes and applications. And one of the things that we're doing that's a little bit different is that we're actually defining what are the integration points that are missing. So when you think about integration, one of the things that you don't always hear companies talk about, well, what are we integrating and what incremental things am I getting because of this integration? So as we go through it, you'll see us talking about these different integration points that mature processes and applications allow you to support. And some of the key ones will be between outcomes and business processes, entities and functions and business processes. And you can read them all. But these are things that are real, like I said, falling between the cracks. And there's some other lesser integration points, if you will, that are that need to be addressed. So the next section that we're going to talk about is profit and strategy alignment. And this is when we get into the meat of the maturity model. So here's the maturity model, and we're focused on profit and strategy alignment. We've got the dimension definition that I showed earlier. So if you look at what the maturity levels are, these are the things that you're achieving at each level of maturity. So the first thing after the first two stages is cross-functional alignment, optimized outcomes, and dynamic strategy. And these are these three up here. I'm going to talk about three specific incremental capabilities that companies don't have now. So we'll keep those in mind. And when we look at the maturity model, like I said, most companies have that are global manufacturers have probably gotten to stage 2. And those are really typically focused on meeting the needs of individual stakeholders like the financial stakeholders and operational stakeholders. And the ones over here from 3 to 5 are all process and outcome based. So what we're going to be talking about is, what are the specific capabilities that get you there? So one of the things I just wanted to highlight as well, when we talk about these various capabilities, there's been a lot of written in the Harvard Business Review about this. One of the specific ones, for example, in 2017, it said great companies obsess over productivity. So this one says the best companies are more than 40% more productive than the rest and have 30 to 50% higher margins. So one of the things as we're talking about these maturity levels, each maturity level has a value associated with it. And one of the things that we're talking about here is breaking down silos and driving value by getting people to focus on the right things. And like I say, there's some other excellent articles that talk about, how do you get people aligned and make the right decisions? And we're really building off some of the ideas presented in the Harvard Business Review. So the first capability I wanted to talk about is the ability to plan and manage simultaneously from both functional and business process perspectives. And the whole idea of managing processes and outcomes shouldn't be new to anybody listening to this video. One of the problems is that we still, despite all the efforts that we put into quality management and business process management or operational excellence and whatever terminology you want to use, is that we're still managing functionally. We still have these silos. So by enabling processes to present something like I've shown on the screen here, where you can always reconcile the general ledger or the budget to activity and process costs, what you end up with is process cost information that people believe is accurate. And it's really the basis for driving strategy across the enterprise, because thing is, if people don't believe the numbers and they don't believe that they're accurate, you're not going to change any behavior. So one of the foundational capabilities organizations need to have is ability to reconcile the chart of accounts to business processes, or in other words, inputs and outputs. So from a horizontal execution perspective, this provides a foundation for executing processes across functions and entities and have models that span functions and entities. So it's a foundational kind of capability. That then provides the ability to manage productivity. So for example, in an order to cash process, we can plan and manage the cost per order, for example. And from that, then we can start managing trade-offs. And as things change, we can manage these trade-offs as conditions change on both a backward and forward-looking basis. So the idea of managing trade-offs is really managing an outcome. So the outcome of an order to cash process is an order received by a customer when they need it. And one of the things that this allows you to do is manage this outcome. So one of the problems in a lot of companies is if you ask them who owns these three metrics, the typical answer is no one, and that's primarily because you can't manage it if you can't plan it. So having this capability allows companies to manage these conflicting objectives. From that, one of the things that you can use this for is to manage these trade-offs and productivity at different levels in the organization. So the focus ought to be, if your plan is $10 an order overall and maybe 5 for one segment, 10 for another, and 15 for another, you should be able to distill that down through the enterprise. So what it allows you to do is to make sure that you're hitting the right numbers, given the assumptions of the different segments that you're working on. This same information should also you should use it to be able to have a ongoing process portfolio management system. So if you see on the right, we show the reduction in cost from a new capability that was implemented, or if it were a forecast, what the forecast would be. So in this case, we could use the projected savings to figure out what the order to cash value would be on the portfolio management matrix. So this sort of thing ought to be something that just is, like I say, just an outcome of a really good integrated rolling forecast process. And you can also layer in other investments like new products. So those are the kind of the foundational capabilities for cross-functional alignment. So what that gets you is a really good understanding of business process costs and productivity, such that you can now form the basis for establishing effective accountability for cross-functional performance. The next stage is another set of capabilities that are required to, how do you translate the product and customer requirements or value propositions down into these processes? And that's the focus here. So if you look at any manufacturer, they probably have some very similar types of things. So one of the things as well as we look at this, I tend to look at companies divide them up into two buckets, if you will. Ongoing operations, which are, you keep the lights on and serve the existing products and customers that you've got. And then anything new that you're working on, which are kind of brand new product lines or new investments in plants or whatever. But if you look at the ongoing operations, there's some pretty standard outcomes that you're trying to manage. So you can see the top, managing towards net profit, customer satisfaction, cash to cash cycle time. Then you work towards retained and profitable customers. And then there's some outcomes underneath that, customers that are ready to buy, optimized product and customer service portfolios that you offer them, and being able to deliver a customer experience. And then you can distill that down even further into processes, and then even further, those are the functions in which they're performed. And you can have performance measures, costing models, planning models, and master data that are common to all of those things. And underneath that, there's some enabling outcomes. So the point here is that if you look at the outcomes of any global manufacturer, there's going to be some nuanced differences. But if you look at the various outcomes, they're fairly similar. So just laying another level of complexity on top of that, underneath optimized product and service portfolios, you're going to have a portfolio for like a product segment, different product segments that need to be managed, and or customer segments. And each of those product and customer segments have different economics that need to be managed. And these are the things that are required for commercial managers to be able to manage the profitability of an individual segment. So when you start looking at some of the things that need to be managed at each level, and I'm not going to go into this at gory levels of detail, but if you look at, there's things that you want to do at each level, so you're trying to maximize something and minimize something else, and these are the trade-offs that companies are trying to manage. So in the case of a customer segment, you're trying to optimize or maximize segment value and growth, customer retention versus delight, while minimizing overheads and minimizing segment inventory. You can see that there's a trade-off associated for each of these different levels, and having this level of granularity and clarification about the outcomes you're trying to produce really provides the means for companies to have what I call more of an internal market mechanism. So you want to be able to translate what you're trying to achieve down here down to here. So if I have a specific customer segment, and my customer has a certain value proposition, or they want to pay a certain amount for a product and service, you need to understand what sort of service levels can we provide them, and what's the cost of that going to be. So having this mechanism to translate high level objectives down to the front lines is a really important thing. So the last level of maturity here is what I call dynamic strategy. And what's happening here is that, when you get to this level, and companies getting familiar and using these different structures, it's at this point where decision rights can start shifting towards more of the horizontal perspectives. And you have more dynamic portfolios for products and customers and investments, where the resources are flowing to where they need them more freely. And one of the things that's also happening here is that ability to take a strategy and balance scorecards that are actually mathematically connected to outcomes and processes. So you always have this direct connection between strategy and outcomes. So in this case here, I've just modified this so that what's in these outcome hierarchies, you substitute the strategy up there in the targets, and you have an optimized investment portfolios. So this is what's happening at an enterprise level. So you're not only optimizing your ongoing operations, but you're simultaneously doing that by optimizing your investment portfolios as well. So that, in summary, is profit and strategy alignments, the key outcomes and capabilities that are associated with it. So the next thing that we're going to talk about is planning and resource quantification. So here's, again, our maturity model, and here's the definition. So the idea of the of this part of the maturity model is that these are the maturity names: informal and ad hoc, formal methods, connected planning, enterprise optimization, and value optimization. And these are some of the key things I'm going to be talking about. The one basic model, prescriptive analytics, and analytics-driven strategy are some of the things that we'll be talking about. And by the way, this should be planning and resource quantification here, a little goof there. The resource quantification and maturity model, as I mentioned, the stakeholder needs, this is where most companies are at right now, where they're adopting formal methods to address stakeholder needs. And these are the incremental ones we'll be talking about here. So what companies already have, a lot of companies have already implemented some of the management methods we talked about before, but just to kind of drive home a point. So from a financial perspective, companies may have implemented, financial planning systems, and you develop some basic driver-based planning systems which are kind of unit times rate systems. And the operational folks may have sales and operations planning that may have some financial estimation included in them. But at this point in time, when you get to this level of maturity, they haven't fully integrated them yet. So what we're going to be talking about is what comes after that. So the first one we'll call connected planning, and I think that some companies are actually using the term connected planning, but it's still a fairly immature level of planning from a global manufacturer's perspective. But let's just first define what do we mean by that. So one of the first things that we have to realize when we talk about planning, it has to do a bunch of things, but it also has to support the productivity management that we talked about. So it's nice that we can do that on a backward-looking basis, but you have to do it on a forward-looking basis as well. So that's one of the things that has to be recognized here when we're talking. So this cost matrix that we talked about earlier, on a forward-looking basis, one of the things that a model is doing is actually allowing you to quantify how much work have we got. And you should be able to actually quantify that work both in terms of value added and non-value added. So for example, here's some in red here, which is non-value added work. And if you've got an activity, when it's connected to an activity planning system, you know the cost of non-value added activities on an ongoing basis. Plus, you're also doing capacity planning, which is, if you do sales and operations planning, there should be nothing new. But the idea here is that we've extended capacity planning to the enterprise. Now, there's some things that you need to do in order to support something like that. So one of the things you need activity planning logic. So you can see what I have in here, like an activity hierarchy, the department and entity it's performed in, required resources, and you can read them all yourself. But these are pretty basic things. So in a good and mature planning process and system should have all this logic embedded into it. And likewise, what's unique about manufacturers is that you need manufacturing logic. So again, things on here that shouldn't be new to people that are in the manufacturing sector. These are the things that really should comprise something that is a shared model that finance and operations have. Now, one of the things is when you put all that up, people tend to think, oh, gee, we're planning at these really low levels of detail, and that's actually not the case. So one of the things that a really good integrated business planning process or mature planning process ought to do is help you maintain a high level model. And these are, people tend to refer to these as planning bombs, and reconcile the planning bombs to the detailed bombs. And they should be done in such a way so that they should produce similar results. So, if you do a bill of material explosion and you're off by 50%, you know that your planning bombs probably aren't right. So you want the ability to ensure that, there's this connection between the high level and low level models. So from a supply chain perspective, a supply chain executive is not going to want to plan. If you've got 100,000 products, supply chain executives is not going to want to plan at 100,000 products. They may want to plan at 500 at the most. So you have to have some way of digesting those things. And that level of planning should provide the basis for a good financial planning system too. Now, along with managing the high and low level models, one of the things you also want to be able to do is to distribute ownership of the model. So if you've got, say, you've different parameters of the model, different people ought to own them. So in the case of the high and low level reconciliation of these models, somebody ought to own that, but people ought to own certain planning parameters too. So for example, from a purchasing perspective, you might have a buyer owning these metrics for these two vendors, and their job will be to update these things over the course of on a monthly basis. But the idea here is you've distributed ownership of these things, so they're maintaining both the high level model and the detailed model. The next thing, you should be able to have multiple versions. So where this is important is when you start looking at, demand and the master schedule that you're going to use to meet that demand. So if you look uh, at a master production schedule over time, there's you have an order book which is represented by this pink box here, and you'll have a forecast, and uh, you're going to be consuming that demand over time. But you always want to be able to maintain a total demand, total view of demand, both actual orders and forecasts over the planning horizon. When you go up a level, this green box represents the sum of the master schedule, but there may be some stretch targets as well that the executives have, which then all have to be reconciled to the master production schedule by week. And underneath all this are different levels of bills of materials and routings that need to be maintained. So down here you have your actual bombs and routings, you have your standard bombs and routings, both budget and current, and you have your planning bombs and routings. Now all of these things have to be kept in sync, and that's where the ability to have multiple views of your bills and routings at different levels is going to be absolutely essential. So one of the areas where this helps is when you're looking at, say, your revenue target. So RT represents a revenue target down here. You'll have collaborative demand, which is really ought to be what the demand planners think you're going to sell. And then you may have some unallocated stretch. So you never want to play around with what the demand planners are saying. You don't want to put in anything that's not known demand, but you may have another part of the system that's and process that's maintaining the unallocated stretch. And this is where you can use planning bills and materials to actually drive all that. And you can see that over the course of time that you have a collaborative demand number and an unallocated stretch, which really comprises, your total revenue. And over time, you can see that can change over time. And one of the things you want to be able to do is manage the volume and mix. So it's important really to have these kind of different views of the model and reconcile them, and have different people who are dealing with these different components of the model to maintain them. Now, lastly, one of the things that a good model ought to do, and a good planning system, is automate the whole variance analysis process. And really, this math is pretty basic stuff. I mean, it's available on the internet, and these sorts of things I found on the internet, which are really just defining what these different things are. But this ought to be kind of a foundational to what I call kind of um, a basic planning process. So that was connected planning. So what we talked about were some pretty basic things. And these basic things actually are, in some cases, a lot further along than some companies are today. But for global manufacturers, what I just described probably isn't going to be sophisticated enough to deal with some of the complexities that you're dealing with. And this is where enterprise optimization comes in. So one of the things that enterprise optimization does is outcome hierarchy that we talked about before. It the models here play a central role in allowing you to plan at that level of detail and utilize those hierarchies to drive the planning process. So one of the things I'm going to be talking about here is the idea of flow-based models. And I just found these on the internet, and you can see them being depicted in different ways and different systems. But what you'll see is just a bunch of lines between different nodes. And that's the whole idea of flow-based models. And from a supply chain perspective, supply chain executives and practitioners, this isn't going to be anything new to them. But really what this is, for most financial people that are looking this is really what I call like driver-based planning on steroids. And this is really the sort of, when you get into really complicated planning, it's this sort of model that one needs to have in order to get the things that you're looking for. So here's a simplistic one that I'll use to illustrate. So in most supply chain models, you're planning from what you're shipping to a customer to the materials you receive, and you got some base activities that you're trying to model. So shipping, storing inventory, distributing products, making products, receiving materials, and here's kind of like the overall processes. And you'll see that in this part of the model, one of the things that these flow models actually end up doing, you'll see these numbers here, 20%, 45, 25, and these ones down here. One of the things that a prescriptive analytics model, which, by the way, prescriptive analytics is a form, it is a term that can describe supply chain optimization type models. It's, they're forms of prescriptive analytics. So, when you look at these different mix assumptions here, if you change them, you can see they automatically get updated downstream. So this ability to connect upstream and downstream drivers is a huge thing. So if you ever, the inability to do this, by the way, is one of the primary problems why driver-based planning doesn't work so well, because you're not connecting upstream and downstream drivers. And if you get into really complicated processes, traditional financial process or financial driver models just aren't going to cut it for the types of things you're probably looking to model. So this whole idea of a dynamic driver is really central and important for both finance and operational people to understand. And prescriptive analytics has certain things that that you'll want to be aware of. So for some of the parameters, put in capacity constraints, productivity rates, and cash flow behavior. And by the way, I'll come back to that in a sec. But I talked about dynamic drivers, event-based drivers. So for example, if one of the events might be I crossed the border, so therefore two things happen: the foreign currency changes, and I have to pay some tax. So understanding events, and then being able to simulate inventory movement is a big deal. And then being able to put in business rules. So one of the key things here is being able to resolve capacity constraints, step change cost functions, and have flow specific bills and routing. So for example, if you move something from one plant to another, it understands how the bills and routings are going to change. So these are just more detailed models than from a financial perspective, what you're used to seeing. And the thing about these models is that, if you look at the number of flows that you're actually talking about, if you have, in the one we just looked at, I had 5 stages, and we have 4 stages per node. You see that you're going to have 1,080 monthly flows, but the more stages and nodes you add, you can see you can quickly add up to some pretty detailed numbers. And these are the sorts of things that give you, the precision and the flexibility that you need to manage a very complicated business. So one of the things that this kind of a flow model allows you to do is take these customer segments and then flow it back through here. And you can add in more nodes along here, but what you're doing is you're basically flipping this this hierarchy on its side here, and then putting it through the model. So in this case, if you had 10 customer segments, you'd have 10 here, and then you can add in more nodes here as need be. But the idea is that to support planning at this level of detail, you need something that's a little bit more sophisticated. Now, to support that kind of model, there's some things that you have to have. Now, some of these we talked about already, which were common to the lower level, the other last maturity level, but there's a few that are really kind of specific to this one. So for example, one of the things that you want to be able to do is connect processes and activities to general ledgers and charts of accounts. And just as well, along with that, you want to be able to take the model nodes. So one of the challenges with a lot of supply chain optimization tools is that there's no mechanism to reconcile supply nodes to general ledger charts of accounts. This is a really big deal. So if you really want to have an integrated scenario planning process, you better have a mechanism to reconcile your charts of accounts to your general ledger or to your supply chain planning model. Now, just following along from that, this is where cash flow forecasting, if you're looking at this from a financial perspective, this is where you can see how cash flow forecasting becomes a hell of a lot easier. because I mentioned that you could literally get millions of lines out of a monthly model. And if you, with the right rules, you can literally, you can identify, the various activities within the model. We talked about receiving materials, making products, distributing products, shipping products. Each one of these things is going to have a journal entry associated with it, but there's a cash journal entry associated with these as well. So being able to put in the various decision rules or rules that drive cash, you can take the output of supply chain model and use it to drive cash flow forecasting. And what you end up with is something that's infinitely more simple to use and a lot more accurate. So one of the things you'll end up with is cash flow forecasting just becomes a byproduct or just an output of a really good forecasting system. And the same is true of foreign currency for exposure forecasting. And this is really where it comes from. So one of the things that's driving this, by the way, is that you really need to have really, really good master data. So, some of you're going to run a lot of what's driving these rules are the planning attributes. So it could be like the material or commodity type that you're using, the vendor type, the source country, the receiving country. There's a whole bunch of things that could drive these rules, but they're all driven off of analytical master data. And that's, something to keep in mind. One of the things is that, especially when you're starting up, nobody's going to implement this all at once. So one of the things you're going to want to do is you're going to want to have different types of models in your process and tool. So not only when you're done you're going to have them, but over the course of time this is going to change. So what you want to be able to do is link your whatever driver model you've got in your prescriptive analytics. You want to drive it, link it to other activities which might be outside the analytical tool. So entering orders, scheduling orders, and over here providing products and support processes. But one of the things you're going to want to you understand is that over the course of time, these things are going to change, and you want to be able to have a model that can adapt to those sorts of changes. Now that I've told you all about the model itself, let me just quickly kind of tell you what sort of outputs you should be looking for. So you saw this before, this order to cash process trade-offs. So one of the things that'll come out of this is days and receivables, and that will form your accounts receivable, and you'll have something similar for payables and one for cash behavior. So it'll simulate this for you. And you can use that as well. You'll have it by currency, and you'll be able to understand what my exposure is by foreign currency. So from a hedging perspective, one of the outputs of all this is that you now have, you don't have to do a lot of this manually. It's something that's, again, just an output of your integrated planning process. And as well, one of the things that comes out of this is, as I mentioned before, is the whole dynamic portfolio. So we've talked about connected planning, enterprise optimization. Now let's just turn our attention to value optimization. So I'm not going to spend a ton of time on this one, but one of the things that we've talked about to this point is the ability to, translate strategies and targets to customers, products, processes, activities, and functions. So in the previous stage, we've been, given a certain target, say a revenue target. What we're trying to do is minimize the cost to achieve the targets or the revenue. When you get into value optimization, you start from the opposite end, which is you're asking the question, what mix of products and customers maximize my cash flow? And once you get to the point where you're mature enough that your models now cover the level or the exposure of the entire business, you can start answering these questions. And with the prescriptive analytics tools available today, it'll give you that, and it also give you insight into the impact of like a foreign currency exposure, tax, and those sorts of things. That'll look at all that from a more holistic perspective. And what's different about some of these newer tools is that when you think about supply chain optimization, what they tend to do is give you one result. But if you're planning from a strategic perspective, there's a lot of unknowns that you may not that you have when you're planning. So the idea of being able to optimize against one thing is a little simplistic. So that's where tool approaches like multivariate optimization should be considered, because you can start looking at, how is my free cash flow going to behave different for different assumptions about sales growth, for example. So you want to be able to look at that. So this is really when you can start looking at your strategy, and you can start using these tools to really understand how's my cost structure going to behave and which paths ought I be headed down. So that is a summary of the resource quantification and the different levels of what's included. Let's just talk about some of the other maturity issues that we haven't talked about. So the first one I want to talk about is, the problem of long planning processes. And the problem is that, it's a sequential planning process where you do your revenue forecast first, and you do one expense forecast and another expense forecast. It depends on that one. And, you can talk about how these different planning tools fit into this, because they're, a lot of them are all sequential as well. What you really want to have is something that takes that in, by having a model that and a planning process that includes all that. It can collapse the planning cycle time. So in a lot of companies where you have, you know, a half a day to do some scenario planning at the end, you can really collapse the amount of time it takes to do the planning and have a lot more time to think about what your options are and how to improve the business. And you can see how these have, just by having an integrated process, it combines all of these different traditional approaches. So just just by way of a summary, some of the things that we've talked about to this point, we've talked about a planning approach that's more entity, cross-entity versus entity-driven, concurrent process versus a sequential. Talked about distributed versus concentrated model ownership, key assumptions being embedded in the model parameters versus in spreadsheets, automated financial operational reconciliation, and end-to-end scenario planning. These are some pretty significant differences between strategic and tactical IBP processes. And these differences really are kind of embedded into these initial complexity gaps that I talked about earlier. And when you're looking at what we talked about to this point, you should understand what we mean by the IBP issue with inaccurate models and how integrated scenarios address that. And we talked about productivity management, trade-off management, concurrent processes, and how having the right tool should allow you to drive, or the right processes should allow you to drive the right behavior. And all of these lead to capturing these value opportunities that we talked about earlier. One thing I think that organizations really need to understand as well is that, like I said before, nobody's going to do this all at once. But the thing you got to understand is that you got to know the endpoint over here. If you're trying to get here, you can't do this first, and design a process and solution and think that you're going to be able to easily do this later. You got to know this endpoint first. Because if you really want to maximize the value and ownership and minimize the time and value, minimize the cost and time to value, you really need to be doing this, because it can mean the difference between, a 2 to 3 year implementation time and a 5 to 10 year implementation time. I mean, it's a very big deal. It can also have a big impact on the value ultimately realized. What's more, I think that if you don't understand this, you're probably not going to get the results from a change management perspective. Especially when it comes to changing beliefs and behaviors. If you don't know the end state, the tactical IBP processes, you're probably not going to be able to make the required process changes to get the sort of cultural and behavioral changes that you're looking for. So that is a quick, summary of what we've where we are now. We're just covered these other maturity issues and just wanted to quickly summarize what we talked about. So this is what we said that we were going to do. So hopefully that you've seen what comprises mature IBP and what capabilities you might be missing. You can see that, we've talked about something which is pretty manufacturing specific, addresses complexity, brings together strategy, finance, and operations, as well as planning and performance management. And like I said, anything I talk to you about today is really based on currently available technology. So I'm not talking about things that are kind of pie in the sky stuff. And as well, hopefully you've understood that, all of these different ideas here, these integration terms, really are part of the same thing. If you're really looking to create value and drive strategy, you need to be thinking of these things in terms of one overarching system that brings these things together. And I think that I'll just kind of summarize here. If you look on the internet, I mean, there's a lot of uh, things being said about integrated planning or integrated this, and they promise the world. But for a good number of solutions that I look at, there's really not a lot of difference between the processes and capabilities that they're offering that weren't available 10 years ago. And they're talking about all these great and wonderful things that they're doing, but you really have to look very closely at what they're talking about, because when you look underneath the covers, there's a lot of things that aren't really driving the value and the needs of global manufacturers. So you need to be careful about what you're looking for. So that is it. And if you have any questions about anything I presented in here, please feel free to use the contact information on the screen. And thank you for your time.